Hi, everybody. This is Jason Trenner, and I'm here with my partner, Don Rissmiller, our chief economist. And we figured we would do something a little different as far as these videos go, and just maybe ham and egg it together and talk about what we're seeing, about what we're thinking about the overall market. As it stands from my perspective as the strategist, I would say the good news, I think, is that the downside is relatively limited in the short term. We're using $120 for S&P 500 operating earnings for this year. If anything, that might be a little bit better than that, just to the extent to which the things have really brought earnings down, which was the strength of the dollar and the weakness in oil prices, may be hard to repeat in 2016. If you use a very conservative estimate for multiples of 15 times earnings, that gives you something like 1,800 on the S&P 500. I think a strong case can be made that the multiple should be higher, maybe not right away, but given where inflation and interest rates are, I still think that a lot of pensions, endowments, and foundations have an issue of getting the returns that they need. So I think the downside risk for this at this point in time is relatively limited. What I think is vexing the market is a standard litany of things that people have talked about, whether it's China, whether it's oil prices, or whether it's really just concerns about a policy error. And I think Japan's decision to pursue negative interest rates a couple of weeks ago was maybe a new front on that score. As Don will talk about, we're of the view that negative interest rates are a long way away in the United States, but by the same token, I think there really are concerns about what the Fed is up to, and we would certainly consider a Fed tightening in March or June a policy error, and one that would greatly increase the chances of recession. So our somewhat optimistic view is tempered by the fact that there are still concerns out there about the possibility of a policy error in the United States. In terms of where to hide, now obviously we have to buy something. I think there are a couple of baskets that we have, a couple of ideas that we have that might work. One is our Thrifty 50. Thrifty 50 is a basket of 50 companies that have the lowest credit default swap spreads and strong balance sheets in the United States. It is intriguing. One wonders, Don, in a world in which you have negative interest rates on sovereign debt, are there really risk-free assets? If you're buying a sovereign bond that has negative interest rates, I would say almost prima facie that's risky. And there are a lot of companies out there that certainly seem to be in better shape. Another, I think, basket that might be interesting would be Dan Clifton's austerity index. Those are companies that have very, very strong relationships with government contracts, and I think presumably if you look at government spending this year, government spending and tax decreases could be something like 0.6 to GDP. That might be an interesting place to be. And those would be two places, I would say, two baskets that you could look at to maybe hide in a world that's a little bit frightening. But Don, what do you have to say?
Well,
is there something I'm missing?
Yeah, the good news as we go through the first quarter here is the economy's hanging in there in the U.S. If we look at the recent retail sales data, that looks okay. That's a January data point. If we look at consumer confidence for February, so far we're not down a lot. And this is in the face of one of the worst stock market starts to the year ever. So I think that says something. If we think about the components of the economy, it's consumption and government. There are some risks to investment. It looked to us like we were trying to bottom out on things like global PMIs, manufacturing, investment last October. That was after the first 50% decline in oil prices that we had. It was a little more than that, actually, closer to 60. What's new news as we've gone into 2016 here is we've had a second 50% decline in energy prices. And that's filtering through the system here. I think that that's something the central bank has to take into account. That's something that international players have to take into account. And that's where some of the stresses come. So when the Fed met in December, put out their forecast, and if we look at what they had in their dot chart, they had 4 rate hikes for 2016. That may have been aggressive to start with, but it was at least feasible. Here, today, after that second 50% decline in oil, I don't think that's feasible. And even if it were, I don't think it's worth it. So if you're a hunter, and you're out in the field, rule would be if you don't know, don't shoot. If you don't know what you're looking at, don't pull the trigger, because that might be a big mistake. And I think the same rule should apply to monetary policy here. Risk adjusted, it does not seem wise to attempt a normalization in this type of environment after the second big decline in energy prices, and also in the context of international developments where we've had tightening in the currency market. The other question mark that's still out there is what's going on in China. The data's not as reliable as we would like. I think that's well known. What we need to see is China either make some adjustment to their currency, put in place capital controls, or come up with some other solution that the market buys. And the risk in the meantime is if the Fed, US policymakers push forward with a tightening that could cause China to take action on their currency, the yuan. That's where there's risk to other emerging markets. There may be risk to European banks. So there's a chain of financial events. There's a tightening of financial conditions that we want to take into consideration. This is showing up in Portugal bond yields. It's showing up in the TED spread. It's shown up in European bank CDS. So this is pretty obvious at this point that there is strain. And this is against a backdrop where inflation expectations are still very low. So if the Fed has several mandates, unemployment, inflation, and financial stability, the labor market in the US looks okay, consumer spending's okay, but inflation's still low and financial conditions are tightening. And that's where we think there's some caution that's warranted in the meantime. So we're starting out okay. We think GDP this quarter should be about 3%, bouncing back from the weaker fourth quarter. When we look at the year, 2.6% real GDP still seems possible to us for the US. Those are okay numbers. So the risk of an economic recession is about 20% in our view. We've had negative earnings numbers. We might say we're in an earnings recession. There's some debate on that term. But a lot of that's been driven by a few sectors. Energy would be one. Another question mark that's come up is the financials. And I think maybe we could talk about that for a while.
Yeah, I mean, I think, Don, as you're pointing out, I think the Fed were to tighten. I mean, it seems, I very much agree with you that it's an asymmetrical risk that they would be taking, where the risks of waiting aren't particularly high, but the risks of, as you would put it, shooting are quite high. And I think that's being reflected in the financials. I think the problem is the financials, or the market as a whole, aren't quite sure what the Fed is going to do. Because, again, they're watching those three things that you pointed out: labor markets, financial conditions, and inflationary expectations. Two of those three are flashing red, but they still seem to be pretty hung up on the first one, and that may be the right long-term view. But for financials, obviously, that would be a real problem. You know, I think, unfortunately, we've been, let's just put it to be frank, we've been wrong on financials by being overweight. But I think my own view is that it's too late to sell, and I think that's mainly because the valuations are so attractive. And I think if you go with the basic assumption that you're not going to go into a recession in the United States, that you're not going to have a global financial meltdown, if you're looking at the valuations of financials, they're awfully attractive. And some of the big banks are trading at really large discounts, 30 to 40% discounts to tangible book value. It's hard to get hurt, and I think the book is much more, I would say, is much more secure than it was maybe 7 or 8 years ago. And I think it's the only way the system can work, and it may be a somewhat circular argument, but I think the Fed has to understand that getting the financials to be involved is an important part of the solution.
And I think clearly a U.S. recession changes a lot of things, but it's always a question of what we make our base case and what we make our risk case. I still think, given what we're seeing fundamentally, that should be the risk case. Given what we're seeing in the financial markets, there's more concern. This is where the central bank should come in by design to try and balance these two.
Is the Fed oblivious to what's happening in the financial market? I mean, this is the question I get.
Yeah.
Or they're...
No, but I think the first instinct might be financial markets are volatile. Samuelson said the stock market has predicted 9 of the last 5 recessions. And so there's this starting point where when you see volatility, maybe it's noise, maybe it's signal, but your first instinct might be, well, let's see. You want to be data-driven, it would be part of the data you're taking into account. But this is where if you're not getting consistent signals, you have to make a call. And The challenge today is it's difficult to pre-commit to a call. Which I wouldn't mind seeing some forward guidance light, where the Fed in this case would say, given what's going on, given that we don't know, I don't think we're going to know by March. I'm pretty sure we're not going to know by June. So let's take that risk off the table. And if we're wrong, we'll deal with it on the other side. Maybe we'll get a little more inflation. I don't think that's the end of the world.
Do we have to wait till the March meeting to know that?
More or less, just because I think at this point, March is pretty much off the table. But it's not a commitment. And I think the ability of the Fed to pre-commit to something like skipping March is just not there. You would get dissents.
Yeah.
And the market may interpret those negatively.
So I guess my own opinion, just kind of thinking out loud here, is that that's a problem. It's a problem to the extent to which you're going to have more volatility until you're sure that March is off the table. If March remains live in any way, even just conceptually, I think it's going to be tough for the market to make a lot of forward progress. And so I think investors, in my own opinion, should probably expect more volatility in the weeks to come. Once those are off the table, though, there should be a decent chance you get some sort of relief rally later in the year.
Yeah, the three things, oil, China, and the Fed, they're related. But those three things are what we need to see resolved, I think, to make some significant progress in the market. The economy's grinding through in the meantime.
Right. I think one other thing that I just saw on the cover of Barron's this weekend was obviously some sort of concern that the election is having some is casting some sort of negative shadow over the markets. But my own opinion, for whatever it's worth, is that it's too early for the market. Has a lot of other things to worry about, and I think probably appropriately, at least when I go out on the road, I think it's nice to talk about, but I'm not so sure, just based on my conversations with investors, that it's changing anyone's investment decisions in the time being. I think as we get closer to the election, it obviously will loom larger. But I guess I would tell maybe our audience out there, I'm not so sure it's worth worrying about right now, maybe later on. But with that, perhaps we can conclude today, and I hope this was helpful. We want to do more of these things. We have a lot of analysts here at Strategas, maybe just give you an insight on the way we're thinking. But if you have any questions that we didn't answer, I'm sure there's many, please give us a call, and we'd be happy to help out as best we can. Thanks a lot.